Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, February 18th, 2022. S&P 500 is currently sitting at 43.37. I'm David Zarling. I'm here with 8-minute splits Dan Gorkuber and the patio pirate Ian McMillan. And I want to pause before we get into a lot of the developments this week and just welcome Dan to the team. This is a big addition to our team. Dan is going to be joining us full time. I'm pinching myself because I think Ian and Dan, Kevin and Pratty are some of the best people and technicians on the planet. And we're really excited to have you guys as a team here. So welcome, Dan. It's official. We love that you're going to be joining us. So thank you for joining us on the podcast, but also helping us get better as a firm and doing what's in the best interest of our clients.
Absolutely, Dave. I appreciate being on here today. And, likewise, the feeling is certainly mutual, just being able to, finally team up and, work hard for our clients and not only, develop something great for them and continue to obviously work hard for them, but also, like you mentioned, work with such a great team and you pile a few CMTs together and it makes for a solid time all around. And, hopefully we can continue to just, get better each and every day throughout the process. So.
Awesome. Very much appreciate it. With that, gentlemen, fair amount of price action, which, as Dan talked about, chartered market technicians, CMTs, we like to study supply and demand. What are we seeing in markets right now?
Supply.
Yes. Now that might actually go as the podcast title, supply. So when you say that, Ian, walk someone through who might not every day spend the time that we do studying supply and demand, what you mean when you say we're seeing supply. Paint
people
the picture.
Want to get right. They're supplying stocks to the market. People are trying to get out of what they own.
Right.
Tired of watching it go down for, your average stock is down. The average stock has been in a downtrend for months. Yeah,
you could argue since about a year ago, February of last year, March of last year.
Some of this stuff is, and it continues to make new lows. There aren't a lot of clues yet as to when this stops.
Right. So more supply.
Go ahead.
I was just going to say to paint the picture, more supply than demand has the S&P close to down 10% for the year. Something like the NASDAQ 100, which has been a prior leader, now down about 16% on the year. Small caps, which is something we've been watching. And if we can use from the highs back in October, November of last year, down 18%. More supply than demand. We've got this price drop, and we're talking about U.S. based stocks. But your point being the average stock, these are just indexes that I'm talking about.
The average U.S. stock, outside of energy and some, like we've said, very select. I know we've talked about, industrial machinery and some of these materials, but outside of that, continues to be very slim pickings. And there's areas that perk up for a few days, hotels, things like that, retail here and there, trucking, and shipping has continued to be strong, but they don't move the market, right?
Yeah. So talk about that. When you say
mid-cap energy companies are not going to move the S&P, unfortunately.
Well, it's interesting that you bring that up. And I think one way to kind of paint that picture is from a market cap perspective. You're saying, your average shipping stock or your mid cap energy stock just doesn't have the size it may be going up, but it doesn't have the size to actually move the market in an upward fashion. And I know that I believe Apple, as an example, is 7% of the S&P 500. Might actually be bigger now.
And it's only down 7% this year. I mean, we still thank God we have Microsoft and Apple. Or where would we be?
Yeah, that's a great point with market cap weighting, how much worse it could be if, Microsoft would be another one. But if Apple is selling off and Microsoft are selling off, the S&P 500 would be much, much worse and would probably be matching what we're seeing.
And
go ahead.
Sorry to interrupt. I want to take that just because it's top of mind, and it's a good point on your point of these weightings. Now the S&P being market cap weighted, other funds that are just actively weighted large, like an ARC. A lot of people have said, well, where would this be if Tesla wasn't, holding up? And I mean, you see Tesla breaking below this consolidation around 900. Now what? I mean, what does that mean for ARC going forward?
So what Ian's talking about is ARC Invest.
It's 10% of the fund. I guess the point is there, and it's 10% of this fund.
Right.
It's held up well. The strategy is down 60, whatever, it's down 60% off the highs. You've had the top holding hold up, relatively well compared to the rest of the fund.
Crushed. Yeah.
So now what if Tesla? Now what if the last standing soldier and the most important soldier falls to its knees?
Which is 2%, which is almost 2% of the S&P 500 as well. And that goes back to, and I think Shane Murphy, one of our favorite technicians, had a really nice table listing the top 10 constituents from 1980 to 2022. And sure enough, Apple's 7% of the S&P 500, Microsoft's 6%, Amazon's about 3.5%. And then you got Google, which, it's got two different share classes. So you want to call that 6 as well. And then you've got Tesla, which is just shy of 2. But it's the largest by far weighting in ARKK, which is a poster child. The reason why Ian's bringing this up is ARKK, or ARK Invest, is a poster child for just the appreciation of assets in growth type stocks off the COVID bottom that we're now seeing get liquidated pretty hard. The supply is overwhelmingly, it's overwhelming demand. And so
7%. And so according to his graphic, we've never really been too close to 7. In fact, we've never been close to 7%.
Yeah. So what's fascinating about this graphic, when I was looking at this, and I give Shane a lot of credit for like putting this together.
This is great.
I mean, you've got, and General Electric, right? GE was around for decades.
Yeah.
And would you agree, Ian, looking at this, that the two largest sequences are probably when GE is 4% of the S&P in 2000, and IBM is 4.3%, and Exxon's right behind it, almost 4% in 1980. Besides that, we've never seen something like this. Do you agree? Do you agree looking at this?
It used to be, so you would say 4%. So 20 years ago, you would have said a 4% weighting is a pretty heavy weighting.
And we're almost double. And I wonder where it is actually.
Double that. With now you've got Amazon at basically 4, 3.5, well, it's over 3.5. Microsoft at 6 and Apple at 7.
Right. And we've already talked about Amazon kind of, I hate using a dramatic term like this, but dead weight. I mean, it's an opportunity cost on a relative basis to the S&P. So really, Microsoft and Apple have done their job keeping the team together. How many times we made the analogy of the team and the all-stars that are on the team, and when those perform well, it carries the whole team. Well, right now, in this current environment, to your point about ARK, for example, Tesla being the all-star in that fund, Microsoft and Apple, the all-stars in the S&P 500, those are almost like the last standers, right? Because when we look, and well, that's not fair either, because Berkshire Hathaway, but like Facebook's an absolute mess. JP Morgan, which is a bellwether.
You had the failed breakout on Morgan Stanley.
Right. So there's plenty to be, either we're close to a bottom because all of the carnage that has taken place since February, March of last year in the average stock, right? It's a market of stocks.
Yeah.
Either we're close because so many of those are like, what are we, 40 to 60%
Yeah,
down?
but then you've also had some of these clean breaks where, I mean, so I would use Shopify as an example.
Okay.
So Shopify, I would say, is a poster child for growth companies over the last 2, 3, 4 years. I mean, from 22 up to $1,700 a share for over the last 5 years. And it's a healthy, I mean, I would say Spotify is definitely or Shopify is one of the more legitimate. I mean, like it's there. I don't think it's based on what could Shopify be. I mean, which a lot of these small cap growth, they're based on potential, but Shopify is a market leader. We're not going to get into all that, but you would think if this was done, that a leader like Shopify would have found support at, I would say, like 840. And instead we've seen it break down. So it's hard for me to find really any evidence out there that the destruction small cap growth is coming to an end. I mean, we could gap up 4% on Tuesday, and I'm willing to change my mind. But to me, I would think names like a Shopify or a PayPal, things like that would be, you'd see some type of bottoming behavior. And
we're not seeing it.
It's just, they jumped off a cliff and it's.
Right. And Dan, you were here almost a month ago to the day. And when I say here, I mean in the office with us. And we gave a lunch and learn presentation, and Ian and I came out and said, it's the most bearish we've ever been. And you brought up a really good point this morning about just the methodical nature of the supply or of the selling that we're seeing. Can you elaborate on that? What we're seeing from a selling standpoint?
Yeah.
What you're seeing?
Yeah. So, I mean, even just taking a look back at, I think a lot of, just higher level behavioral mindset of, we're all very aware, market participants are very aware of, obviously, the COVID crash of 2020 and just how fast and how quick that entire sequence happened from really start to finish. And now we kind of fast forward to, now the last 2 years, year and a half, and more recently here, in 2022, where we're seeing that sell-off, start to, really take shape and take place here. I would say more along the lines of the bigger indices. And it's on the bigger indices, it's very methodical in nature. We're down 200 points today, almost 1.5% in the NASDAQ right now. And it just seems very, methodical selling throughout the session where, like, as we mentioned during COVID times, it was, you were seeing 200 point swings in a matter of a couple hour session.
Right.
And like you brought up earlier of, we were kind of expecting, circuit breakers, every other day or every day to hit, whether it was the upside or the downside, where during this type of market, it really hasn't happened, again, to the bigger indices. When we look at like individual names, I mean, those have been, obviously a lot more volatile in nature. And maybe that goes to the fact of, the supply issue of, people just want out and are maybe rotating a little bit more than straight, just straight selling. And there's more rotation going on, underneath the surface from that perspective.
For sure. And I what I think is interesting, and you kind of touched on it, is there's really two different audiences that are listening to this right now. And so we've got clients who, and this is an appropriate relationship, that the COVID crash may not have felt so bad for two reasons. If they were looking, we were managing risk, we were able to keep that drawdown not so bad. Or two, they didn't look because they're not in the industry every single day.
Sure.
So the COVID crash and recovery was so quick, so fast.
I mean, if you're just someone who looks at your monthly statement balances,
it's almost as if the COVID crash didn't happen.
Right.
And so now we're in a scenario where, okay, people are like your average person is now experiencing a sell-off, whereas the COVID crash, they may not have for two reasons. Like Ian talked about, they didn't look until their monthly statement, or two, they didn't look at until their like June statement because of loss aversion, right? They knew what had happened, didn't want to look at their statement, and oh, thank goodness everything's back to normal. But here we're in a scenario where the VIX, or the volatility index, and for those who aren't familiar with that, it's just a measurement of price swings that we could expect to see. We're at a level where back during the COVID panic, is what I like to call it, in February, March of 2020, we were seeing limit down scenarios in the overnight session, and we really haven't seen that. Is that a fair way to describe that? Like that period had limit down and sometimes limit up. I believe there was one limit up in there. We haven't really seen that. Could that still unfold? I think that's definitely a possibility. If we get above these levels in the VIX, that we could all of a sudden now
VIX
start to
above 30, what are you going to say, 38?
Yeah.
35, 30, 38.
I mean, those are some.
And we continue to make higher highs and higher lows for the last 4 months since late October.
Yeah. Okay. Great point. Talk about that. You're talking about the VIX making higher lows and higher highs, right? And the S&P, like something like the S&P 500 had been making new highs until January. So that we would call that a divergence, which is something to pay attention to, right? You got this volatility instrument indicating there's going to be massive, well, how do I put this? Increased volatility going forward.
Yeah, I mean, environment is right. Yeah.
Sitting at, rule 16. So you're expecting it, over percent over. I mean, that's almost a 2% intraday move.
Yeah. Yeah.
At 29, you get to 32. That's 2% that you can pretty much count on there being.
Well, and I want to say
above that. I mean,
how many? What did you say that calculation was? 1 or 2, 1.5%, 2%. I don't even know.
Okay.
We haven't necessarily had a 2% down day, with the exception of maybe
yesterday,
right, and February 11th. So there's been some of that. But the point, going back to what both of you have been talking about, is during the COVID correction, which happened so fast, there was these overnight limit down scenarios, which we haven't seen yet. And the methodical nature of selling it's been pretty orderly so far.
Yeah. And I think that can be right. It's, the so far nature. I think, that we might get into some bigger levels later in the podcast where, you can bring that so far statement to say, hey, if we're below X, that so far statement now becomes, we could open up some of those bigger moves, and that volatility can obviously start to expand. Which is
really an interesting dynamic, because for it to expand further than 28 on the VIX, to me is in general, it's a general statement to say you can have upward moving markets with high volatility, but in general, the higher the volatility, that tends to be a characteristic of downward facing markets. So related to that, we know that markets move with liquidity. What are we seeing in that area of the market as far as liquidity goes? Maybe if one of you guys want to describe what liquidity is, and then what we're currently seeing there. Don't all jump at once.
Go ahead, Ian. You can take that one.
Yeah, I mean, I don't know if I can give like a great definition of liquidity.
Can you give maybe like an example or an analogy?
Of like shares being like when people want to buy and sell, they're like being another person on the other end of that agreement.
Perfect.
Like the ability to find a matching side of the trade.
Yeah. I think that's perfect. And when you can't, that's lack of liquidity, and it causes
lack of participation.
Yeah.
On both sides. So, there seems to be some issues. People that know a lot more about liquidity than I do, and kind of how to measure it and things to look for, say that there seems to be liquidity issues. Heard and read things about, the firms, the big guys with more assets than us. And I would say even our list of names that we have been able to play in has gotten small. So if you think about guys that are managing, billions of dollars, getting in and out of things is pretty hard right now.
Right. And Dan, you brought up, I know you look at some of the contractual things that are going on with the NASDAQ, that some of the exposure that you saw there, is that a measurement of liquidity? Like when we see contracts drying up and they're not there, is that a fair?
Are you speaking more on like the delta?
Right. Yeah.
The cumulative delta. Yeah. I mean, you could probably dissect liquidity in two different ways, and even maybe with the supply theme that we were kind of running with earlier of just saying, these, generally speaking, a lot of, NASDAQ, your ES, your S&Ps, ETF world, SPY. I mean, those are going to be pretty liquid in nature, no matter what is really going on. But you take certain time periods where if we're not seeing aggressive buyers really step up to the table, well, now we're going to have to see maybe the spreads are going to be, spread of the buy and sell are going to be a little bit wider to where, sellers are going to have the advantage, and we have to find that equilibrium in that supply demand chain to kind of equal it out. And
it's pretty common in markets that have higher volatility that the spreads between the bid and the ask, move out. And so while we've given a fair amount of time to equities in general, and we've been US focused, and I don't even know if we're going to have time to get into international because there's something there too. But I think it might be more important, besides an international, just to talk about commodities a little bit and what we're seeing in that arena. And I'll let either of you guys jump on that as you see fit. But I think there's definitely beyond a story there.
Yeah, you have wheat, you have KC wheat, just the wheat market as a general, really, really strong here today. Grains, following suit.
Dan, KC wheat, Kansas City wheat.
Yes, that is correct.
Okay, what other types of wheats are there?
Because there's going to be Chicago wheat. Kind of looking more on the futures front now. But
that's deep dish wheat.
deep dish wheat.
The other one's like barbecue wheat, like.
Yeah, and then there's even Minneapolis wheat, believe it or not. So it's, but it's going to be more along the lines of higher level, grains, right? Grains are all holding pretty well and have been holding very well here over the last few weeks to a couple months, and even expanded out to metals joining the party here now over the last few weeks. And obviously, we all know crude oil and the energy products have been just on a tear as well. So, commodities as a whole, just, continuing to kind of buck the back and forth volatile nature of the outside world. And,
where do you guys think people are on, I know where we are in our commodity exposure, but right, the 60-40 portfolio, 60% stocks, 40% bonds. I don't see a number in there for commodities. I mean, it seems like an opportunity that might be missed.
Yeah, I mean, that's been the only, and it hasn't been just, the agriculture type stuff. So, I mean, some of the metals have been pretty good. Aluminum, tin continue to act.
Minneapolis
really
tin
well.
Or Kansas City tin?
Detroit tin.
Oh, 8 Mile tin. It's the best.
Oh,
in honor of Eminem's Super Bowl performance.
Oh, it was great. It was great. It was great, and it made me feel old. Let's put it that way.
Did your kids know what the songs were?
No. My kids? No.
No?
I mean, yes, my oldest, yes. But then then I'm sitting there looking at Eminem's dyed beard, and I'm like, okay, like how much are we pretending? I loved it. Like, don't get me wrong, but I don't know. I feel like we've made the transition to like, remember when Rolling Stones and all those guys used to do the halftime shows, and now we've got Eminem. I don't know.
Yeah,
I don't know if that's supposed to be
from Prince to Dr. Dre.
50 Cent upside down. Like
I heard there was a Dr. Dre joke about he's about the only doctor we can trust over the last 2 years or something. We can save that for after
Dan
our
making an
podcast
appearance on the show.
I don't know. I just saw it out there. I wanted
Dan
to
coming in with a splash.
Oh man, off the top rope. I love it. This is great.
I mean,
anyway.
I mean, no one's saying he's lying.
Who else drops Kansas City wheat and Dr. Dre as the doctor we can trust in the same podcast? I know no one. Well done, Dan.
Should I just show myself out now, or no?
No, you're good. You're on. You're still on. No, you don't get to walk away from that. In flipping back to equities a little bit, and I know we tend to focus on U.S. equities, and I think we're going to save the international equities for the next podcast just because of time, because there's something there, especially since
there's something going on. I don't know if they're going to outperform to the downside or what, but there's strength going on there, and it's not China.
Right. Latin America is,
and when Mexico, Peru.
I know I remember asking the team at the beginning of the week, like, true or false, emerging markets is positive year to date, right? So here we're talking about the S&P being down almost close to double digits, and emerging markets is positive. I mean, it's worth taking note of. Now, you look at a chart in that relationship and you're like, like there's still some work to do.
Sure.
But focusing more domestically, an area that had been showing, I don't know where you want to consider this area, industrials. I consider it economically sensitive area. You want to see it perform well. What are we seeing out of industrials?
I mean, like we said, for some of these small and mid cap type names have been okay, but again, they aren't going to move the market. I mean, Deere, was really hoping Deere was going to get through 400. Doesn't look like that's going to happen anytime soon. And Caterpillar, is Caterpillar the most important industrial? Probably not great. I mean, Caterpillar unable to hold 200. Caterpillar below 187-ish. Kind of dicey. 192 now, but it's not
remember our discussion about some of those failed breakouts a couple of weeks back, with like I think TSM was one.
Right.
And Deere kind of look, you get some of those breakouts going and then all of a sudden it fails like that. Are we just kind of seeing a delayed reaction in that type of name?
Could be. I mean, industrials as a whole has been in a range for a while. And those are the leaders, right? Deere and Caterpillar are two of the bigger names in industrials. And that's an area you want to see move higher, along with like semiconductors and tech. And that's just an area that you like to see participate to the upside. It doesn't have to outperform.
Yeah. And I mean, industrials unable on this last rally attempt that they had late last month. I mean, not even able, I would say. So it rallied up to 102, which is, I would call that the midpoint of this range it's been in. So the inability to get back up into a range, the top half of a range, RSI cannot, it closed above, I don't think it ever got above 50. So that never got back into like a bullish range. Very, very weak.
Yeah, for sure. I completely agree with that. And related to that, on the flip side, staples, right? So staples kind of a safe haven. If you think about mandates, when people are managing funds and they've got to be 98% invested, they might be able to flip to staples and protect some of their capital.
Mm-hmm.
What are we seeing out of staples in an environment like this?
They look pretty decent. I mean, they're holding up. Not bad.
Some nice continuation patterns.
Relative.
And so is that risk on or risk off?
Yeah, I don't think people piling into Coca-Cola and Procter & Gamble is amazing.
Right. Well, and I believe we had an exchange this week about Philip Morris. Is the world okay if we're buying cigarettes and gold?
And Dr. Pepper.
That sounds like a great Friday night. Dr. Pepper.
I mean, I want to see people buy. I want to see people buy. I just want to see people stop selling Shopify and Roku.
Oh, Roku.
Things right. I mean, how many story stocks have been blown up? And I'm not saying the story's not real. I think we have 5 Rokus in our house, but they don't.
You have us outnumbered. We only have 3.
Yeah, I mean, it's an awesome product, but it's down 79%.
Well, and okay.
And you've had so many chances to sell this.
I was just going to bring this up. So one of the powers of being technical or having an understanding of supply and demand is it's one thing to buy something. It's another thing to sell it. And of course, it's easier to say, when would you have sold Roku? We never owned Roku. But I mean, Roku's been is it fair? Can I say Roku's been a mess since November of 2021? Like, why would
I would even say February 2021?
Yeah, right. Because yes. So it's the power of using supply and demand, price, investor behavior, whatever you want to call it. It gives us theses to work with, and only price can confirm or deny. And right now, the price continues to confirm that Roku's a no-go. I mean, and like Ian said, I like Roku. I like how easy it is to use.
And I'm sure their earnings are great. Like, I don't think Roku's going anywhere.
Well, the stock's going down.
Yeah, it is. It's what it is.
Yeah.
It's right on. Ian, weren't you saying it's right on IPO rate of trend line right here today?
Yeah, I mean, we've broken it. In fact, we broken it. Yeah, we've broken. I mean, it's been in an uptrend for 4 years. You could have said until today.
I was going to say some technicians might say what just happened overnight is a measuring gap, which would be pretty amazing if that's true. Only price can confirm that, because that'd be a further 70% down to the downside. So that some of these prior high flyers continue to get sold. What other risk on, risk off measurements can we look at? We talked about staples. We talked about industrials. We already know some of the semiconductors have cooled off. But are there other ratios?
Cryptos failing to hold. Mm-hmm. Bitcoin can't hold 43.
Yeah,
I would say. Yeah, I mean, meme stocks have not caught a bid. I know that's like a horrible.
What's a meme stock?
Like AMC and stuff. Those stupid little companies that. Whatever. I can't go there. I'll get. FCC is going to be up our butt.
And another, just going on a relationship perspective. I don't know if you want to go into like the SPY IEF.
Sure, absolutely. Jump into it. Let's talk stocks versus bonds.
I mean, I don't know. Like, for me, if I could take one chart and just try to figure out, the environment of risk on or risk off, and just like what are in terms of expectations, right? That SPY IEF, and I know we've kind of pounded the table on it in a few sessions, but it's just it's a mess right now, and it's not it's not really tipping the hand to either side, the bulls or the bears. It's in a very consolidated type of situation right now, and we have good levels to play off of it for sure. But again, I'll come back to it. It seems to be more of an environment of expectations of saying, hey, if we're not seeing a good, healthy trend, whether it be upside or downside, how does that carry over to the rest of the market and what to expect with, potentially individual names and whatnot. So,
well, and IEF is your 7 to 10 year treasury bond. And overall, when we look across the whole spectrum of credit, they haven't wanted to own any credit except for maybe some floating rate, maybe some Chinese bonds for a while here since the end of last year.
Muni bonds.
But here we're at logical spots for across the spectrum in treasuries, whether you're looking at 7 to 10 year, you're looking at 20 plus year treasuries. We're at areas where you would expect buyers to show up. Now, there's two ways to look at this, right? Because if buyers do show up and bid up treasuries, are they doing it in an environment that they want to own treasuries, or are they doing it in an environment where they would just want to get out of equities?
Great point.
And that's where we're at, where we're seeing like the trade weighted yen, we're seeing gold, we're seeing treasuries get bid, and those are three of the biggest liquid markets in the world. And is that what's going on? That we're seeing that we're going to see an acceleration in the selling of equities, and that's what they're buying to hide? Or is this just a logical place to accumulate?
Yeah, it could just be a relief bounce. I mean,
right.
Treasuries have gotten hit pretty hard. Still in a downtrend.
When I look at something like as simple as TLT, and this 134, 135 level is so huge. I mean, it's a pretty big, if we break below that, the thesis of higher rates is fully upon us, like in our face. Now, we could bounce from here for now and rates stabilize, and that's perfectly normal too. And we could bounce from here also because this is where people want to hide out while equities sell off. So it'll be interesting to see how this all unfolds. Real quick, because of how fun this has been and how quick the time has gone, what are some price levels you guys are looking at, whether it's on an indice, it could be a commodity, it could be bonds, you name it. What are some price levels that you're looking at for evidence of either supply or demand and directionally where we head from here before we go into the extended portion of the podcast?
Sure, go ahead, Ian. You can take it first.
No, I don't really have anything other than the trends continue down. I don't see any evidence. It's just been 2 months, and people constantly try to tell me where the bottom is. And, if you were going to ask me, Ian, what do you want to see that would make you think, stocks are going to turn around and start going up? Not to sound like a jerk, but I want to see stocks go up. I want it. If the major indices are going to go up, then they'll stop going down.
I was going to say, why don't we clear QQQ 350 first?
Yeah, I don't put if IWM. whatever levels that need to be overtaken to make you think that the market is going to turn up either over the intermediate or long term. Pull up a chart, put those levels, draw them ahead of time when we're not in the moment, when you got a clear head. Do it like this weekend when you don't have all the other emotions, and say that I'm willing to get long when this closes above X. And then don't worry about what happened on the last hourly candle.
Right. How about we just get Qs above 350 and see IWM above 209 before we start?
IWM back of the range starts it. And they can go back up to 209, 210, 211, and they can, sniff around out there and bring it back down. And to me, that's the type of behavior of a more elongated bear market.
Mm-hmm. Yeah, absolutely.
The really bad draw, where just every level gets whipsawed back and forth, and you've just got to say, I'm going to be long or short above this level. And it's painful, right? We've had days that have gone against us. but our thesis has remained pretty consistent for the last couple months.
Yeah. Thesis remains supply has control over demand as long as we're below 350 in the Qs, as long as we're below 209 in IWM. S&P 500 is at a really important level here, whether you want to call it 42.75. We haven't gotten there yet. But if we're below 45.30, supply has control. And I don't know. I really don't want to overcomplicate it beyond that. Dan, go ahead, Ian. Go ahead.
No, I was going to say like why it's a time to not complicate things.
Right.
For sure.
Ever a time to like just look at the chart. Like, I beg of you.
Right.
Just worry about the chart.
Don't worry about the blinker. Don't worry about your window. Don't worry about your rear view mirror. Don't worry about cruise control. Just focus on the steering wheel and your brake accelerator. That's it. That's it.
Yep.
Don't get in an accident over something because you're looking at something stupid. Dan, anything from you on spots or prices you're looking at before we go into the extended portion?
Yeah, I think, just on the SPX, I mean, really still really kind of honing in on that low from January 24th. That's essentially more of our spike low here for 2022, right around that 42.20 area. I would think, okay, that's to the downside. Do we start to see that if we hit that and go lower, do we start to see that methodical nature of selling now become accelerated, and really start to open up things even more? And then conversely, obviously on SPX, until we get outside of, like we talked about, this range of, call it like 42.20 to even 45.85, I mean, we could just be in this choppy range. And, again, it just has to set our expectations to kind of what we want to get out of this market at the end of the day.
Yeah, for sure.
Or what the market wants to give us,
Totally agree. Only price can confirm or deny a thesis. And so with that,
yes.
Fellas, I'm more than elated that you guys are on the podcast with me today. We're going to close down this portion ahead of the extended portion. Everybody listening, we appreciate it and hope you stay on. We're going to talk very quickly. It's going to be a very short extended, so we hope you stay on. Just talking about some weekly candles that we're seeing, whether it's international or credit markets, you name it, maybe even some failed breakouts. We'll talk about it for a very short period of time. Hope you stay on.
Have a great weekend, everyone.
All right, gents, we're going to hammer out this extended portion because we got to get back to our day jobs of managing risk. I wanted to talk really quickly because we're starting to see some weekly candles come in. Obviously, we don't have the weekly close just yet, but are we seeing anything from a weekly data perspective that is worth taking note of?
Yeah. We're closing off. I mean, we're closing off the highs again on most stocks and ETFs.
Yeah, you test higher earlier in the week on a lot of these broad indices, and with a little over hour and a half left.
3 huge upper shadows on the last 3 Qs weekly candles.
Oh yeah, I see what you're saying. So we reached levels that got sold off pretty hard intra-week, which are recording some weekly candles that.
Check out SMH. Look at those last 4 weekly candles.
It doesn't really give you.
No one wants to own it above 275.
Yeah.
No one wants to own semis, and that is a bellwether. That's not. I'm not saying we can't go into a very value-oriented environment. Would rather just see semis underperform to the upside rather than potentially have, an absolute drawdown. But and get what we want, do we?
Right, exactly. And I think it goes back to some of the weekly candles we saw last week, back to back, for an area like housing, which, could have been a precursor to some of the selling in that area. And we see the same thing in emerging markets. So here we have one of the best areas year to date, emerging markets, and back to back weeks with upper shadows, which means selling, just like you're talking about with SMH or with semiconductors. And so if we're going to start selling the best performing areas year to date, that's probably not a risk on type environments.
No.
Right. Not at all.
And then on the flip side, risk off, looking at weekly candles.
Gold's going
there's
to have a
something-
nice breakout. We didn't talk about it in the first period, I don't think, but gold, I mean, and other precious metals like platinum.
So breaking to
very
the
much-
upside.
Yeah, breaking to the upside. Big, nice green weekly candles. Again, I know we have an hour and a half to go, but as of right now, not too shabby.
Not too shabby. And I guess I would add, that's going to be the highest weekly close since we've had back in May of 2021, if I'm using something like GLD. And so there's a couple of ways to look at that. Is that a commodity thing? Which it could be, because we've seen commodities do well. But we look at the weekly candles on something like TLT representing treasuries, and those look like they've gotten a bid the last 2 weeks. And this would be a logical place. We talked about this earlier in the podcast to see accumulation.
Mm-hmm.
Now, what's the relationship between TLT and gold, or I'm sorry, treasuries and gold? Well, they're both risk off. That's where you hide. And so
Bitcoin with a couple nasty weekly candles.
Yeah. Okay.
I guess those are going to trade through the weekend, but I mean, they just don't want to own a lot of, Chinese, like I said, everywhere you look, I mean, the last 2-3 weeks, everything closes well off the highs.
Yeah.
Cannabis going to have a and cannabis looked like it had something going. It's going to have a nasty candle. Look at FANGs, FNGS, just very, going back to use Dan's phrase, just a very methodical sell-off.
Yeah, man.
The cool, I think, I don't know, this is probably maybe more opinionated, maybe more factual, we'll see, but the coolest part about these inflection points that we're seeing the last couple of weeks with these sell-offs is that, we're able to lean and position one way, right, with that, but then we're going to know pretty quickly. I mean, if we come right back through those inflection points and those fade offs, I mean, we got something else cooking and we're going to know pretty quickly what
those are clearly big behavioral levels.
Yeah.
Where people want to sell that asset. They want to get out of it. And they're using it as a chance to unload. We talked about supply earlier in the episode. This is a great visual of supply.
Exactly. Yeah, exactly.
And we're in an environment
Uranium,
where
in so many areas, that metaverse stocks, uranium, just brutal. Anything techie, solar, nasty weekly candles.
Well, and another thing noticed this week was just the failure of breakouts.
Mm-hmm.
Right. So we talked about risk on, risk off areas that have these not ideal weekly candles. Now, this can all change in the next hour and a half. But as it sits right now with the data we have, it looks very risk off. And the breakouts failing doesn't help. You brought up Morgan Stanley as an example before. When you're seeing breakouts fail, that goes back to and I don't want to sit here and pretend I'm 100% a William O'Neill disciple. He's a little more fusion than I am. But his point remains that in bear markets, you will see breakouts continually fail.
Yeah, the breakout scene is not any better than it was starting last March, April, when they just started to fizzle. All of them, most of them.
Well, and I think that, so here's the deal. Let's say we do, somehow have a weekly close or some type of correction that's near 43 or 42.75 in the S&P 500, and we rally from that point forward. So we have a 10% correction in the S&P 500 or the NASDAQ, let's say we do go to 300, which we'll just be conservative. Let's call it 310. So it's 20% correction, which for whatever reason, people label as bear markets as 20% correction. But can't we argue that we've already been in a bear market since
I
last
think most market participants would tell you that it's been a
right since
pretty
February,
rough
March
market
of
for a
last
year.
year. Right since February, February or March of last year. I mean, we're seeing some areas down 60-70%. Like I feel like that's a bigger bear market indicator than 20%. 70, 60. I mean, seems like more. There's the flip side of this too, that if those areas that are being just demolished stop going down, if they would just stop going down, we might have an argument for here's where we're going to base. This is where we're going to base and move higher.
Yeah.
Until we see that,
very good.
I don't know. These high growth areas that you guys talked about that continue to get sold, we have to stop seeing that. And it sounds so simple. I hate to be so simple, but stop selling, and then we can see where the buying is.
Yeah, let's let the big dogs be the first ones to attempt it. We don't need to be the first ones on the train. I
Right,
guess.
exactly.
Right.
Well, who knew you could hide out in energy along with gold to hide from some of the selling? Didn't know. All right, we've packed a lot into this episode. Anything you guys want to wrap up with before we shut it down?
Just that I continue to expect this to be pretty choppy. Maybe we're entering, I guess it depends on what asset you look like. You could say a wave 3 for some of the major indices, maybe a wave 5 for individual stocks. But again, and maybe they're buying it here as we sit here and stare at it. So maybe we'll get a good close today and some of these weekly candles won't look as bad. But that's going to take a lot of effort.
Well, yeah, I mean,
in the next,
even if they close and they close S&P 500 around 4,400, it's just a massive doji, just a massive wide ranging doji of indecision. If that's what they decide to do, and it doesn't fix anything with, when we haven't even talked moving averages, with the moving average for the S&P 500 being around 4,450. And so you wanted to see that hold and it didn't. And I still go back to, nothing good happens below a 200-day moving average. Maybe something does this time. Maybe we move higher from here and we reclaim the 200-day moving average around 4,450 and we obey the seasonality, right? Because we're supposed to have positive seasonality now through April.
There you go. Yeah.
And if that doesn't happen, that's a clue as well. If we have negative performance now through April, that's huge information. So we'll see. But you guys are rock stars. I appreciate you guys doing this. I apologize for cutting us short, but we've packed a lot into this. Our listeners are getting a lot out of this. We hope you guys continue to listen. We'll do this again in a week, and we hope you enjoy the 3-day weekend. No market volatility on Monday unless it's through futures products. Enjoy it, and then be ready for next week. Thanks, guys.
Yeah, thank you, everybody. Have a great weekend.
Have a great weekend.